Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. We are on Instagram Live, so we have a live audience, and I'm going to do this without any notes, but we have a lot to talk about. I particularly want to talk about Rivian. Now, Rivian is the electric vehicle company that Amazon invested in that recently IPO'd, and a lot of otherwise intelligent people were very quick to buy shares in this company. Yesterday, and this was not recorded, but I can remember what we talked about. Someone said to me, they said, well, Rivian, they were, Amazon, they have a contract with Amazon. And while that's great, my response was, and this is not eloquent, and I'm going to edit this out, but I said, who gives a f***? And the reason I say that is because, big companies like Amazon, they have lots of contracts. But just because they have a contract with a company, that doesn't mean you want to invest in that company. And that's just one of the reasons why I wasn't lured into the Rivian, what I call the Rivian trap, because Rivian has shown no revenue, and you have people piling into something based on the Amazon affiliation, the what they believe to be the space, meaning electric anything right now, and especially electric vehicles. Everyone's just like, well, that's going to make money. But we know, if you've listened to any of these episodes, we know that doesn't make sense. Even though it seems to make sense intuitively, a lot of the best wisdom about investing is very counterintuitive. So it was funny, last night as we were talking about Rivian, I went on their site and they sell merch, which to me, it's not actually a red flag, but like there's something about that's a red flag. So, and then I went to their S1 filing, and sure enough, they talk about how they do generate revenue from their merchandise. Now, they weren't claiming that their merch business was like driving, the future of the company, but it's just funny to me. Like, I don't know. I just feel like optically, I don't know if you'd want to have merch, but who am I to say? The bigger point is I would not invest in Rivian if someone tried to force me to. I would not, because there's no track record, and it's very much, playing into a lot of these cognitive biases that get us to put our money in something that really our money could do better elsewhere. So what I want to talk about, though, with Rivian and just generally is this idea that because a company has a relationship with another company, that somehow that means its future is bright. We just need to be a lot more thorough when we're thinking about what determines or what makes a company worth buying if you're going to buy an individual stock. I did an episode recently. It's called the Bad Business Checklist, but I took everything that Warren Buffett and Charlie Munger have said about what makes a good business good, and I wrote the opposite of those traits or those characteristics. And from that, after removing the redundant items, I came up with 18 different characteristics that make a bad business bad. So if you're interested in learning more about that, and I recommend you check that out, that episode is it's live. It's been up there for I think a few weeks now, and I've gotten great feedback from it. So I think if you're going to buy a company and you use that checklist, it'll stop you from buying something that just doesn't have as high a probability or isn't a sure thing in the way that you'd want if you're buying an individual stock. Now, as I always do with these, I tell everyone, if you leave me a question, you can put them in the question queue on Instagram. I will answer all of them, and I'm going to answer them in order. I've not seen the questions, so I'm going to load this up right now. And I will even answer the troll questions. So let's check these out. We have, I think it starts from the bottom up. So the very first question from Byrne about my thoughts on MicroStrategy. I don't like that company because I think that the CEO, I don't trust him. And I think you really have to believe in the management in any business. I think that he's done really well taking a big risk on putting so much cash into Bitcoin. But it's just not somebody that I want to... that I have a lot of faith in to do right by me as a shareholder over the long term. That's just my opinion. Spencer says, what are ways to correct regrettable investments, as in sell at a loss, lower average price? So thanks. That's a great question, Spencer. My rule of thumb is, have a cutoff point. As you go down, let's say your investment's down 20%. If you're honest with yourself and you really didn't know, and this happens, right? I'm not saying this is just you. I've had this happen when not even that long ago. This happens it's easy to have this happen. You get excited about an investment. You convince yourself that you've really done the research, but when the stock gets very volatile, you suddenly realize, wait a minute, I didn't know this company as well as I probably should have. Or if you're in the process of just self-education, you reach a point where you say, wow, I thought I knew something 6 months ago, but now I realize that I knew nothing. And both of those are, by the way, that's two examples of progress if that happens to you. So if that's the case, my recommendation is cut your loss and just preserve the capital. There's no shame in that. I think the big mistake people make is they let it go down, 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 down. And as we've talked about before, I think if you go down 50%, you need to make back 100% to get to even. And that's obviously something that you should all keep in mind. It's very easy to. So I think have a cutoff point is what I'm saying. I think what that cutoff point, it's up to you. But if you're taking a big loss and you're honest with yourself, just cut your loss. Stop the bleeding and do something more responsible with the money. And recognize that you're going to have losses from time to time. Don't beat yourself up over it. Just make sure you don't make the loss something that is a lot harder to come back from. That's my opinion. Question here from Ian. Why do you think some NFTs are selling for hundreds of millions of dollars? Because people buy stupid stuff for stupid prices. I think the NFT thing is a total bubble bullshit circus. I just think I can just sniff out the people that are really excited about it. And I don't mean this to every single person who's into NFTs. It's not fair to put this on everybody. But the people I see who are most vocal about it, they make my radar go off a little bit. Clearly there's ways for people to make quick money doing it. But I always try to ask myself, how much longevity is there in this? Can I do this at scale? And if I can't, then I don't want to invest time into it, because I'd rather put that time and energy and effort into something that, is going to sustain and be able to grow over the long term. And I mean, even just with a skill or just something that you're paying attention to. So I think the NFT stuff, to answer that question a little bit more succinctly, it's speculation. I think because someone thinks they can sell it for more to the next person. Okay, Startup CA, aka James, says index versus REITs, your personal opinion. I'm assuming you mean like the index funds, like the S&P 500, VU, or something like that. I mentioned yesterday, not everyone was here, but I don't own any REITs. I'm not against them, but I don't have any strong opinions about them. I am a fan of index investing, especially for the majority of individual investors. As much as I've gotten better at picking stocks over time, probably the most logical thing to do would just be all in on the index, to go all passive. Because at the end of the day, all the research points to the same things. Individual investors are terrible stock pickers, and we're not in control of our emotions the way we think we are. And those psychological errors can cause us to panic sell, to, just all the things that can happen that would interrupt the compounding process and also potentially limit the rate of return that we achieve over a long period of time. So that's my thought. By the way, I feel like I'm just in the zone right now. If anyone else is feeling this, make sure to hit the heart so I know. But this whole process has made me so much of a clearer thinker about everything about investing. So I'm appreciative that you guys have questions for me to, exercise this brain muscle, whatever that means. Last question I have here is from Becker, who says, hi, what are your thoughts about crypto? My thoughts on crypto is it's not something to ignore. I think as a technology, it's really cool. I think the blockchain is here to stay. I think it's a pretty fascinating development in technology. I think it's something worth being aware of, paying attention to. Now, crypto as an investment, I think right now it's totally speculative because there's no underlying value there. There's no intrinsic value. And as much as people will say, well, that doesn't matter right now, eventually it will matter. And so there's no way to time when you should get in or out. So I think if you do invest in crypto, and I do, about 1% to 2% of my investable assets are in crypto, it's something that I'm fully prepared to lose. And it's just basically like, I'm aware of what I'm doing in the sense that I know it's speculative and I don't feel like I'm putting myself at a huge risk. I've also I've done well with crypto, quote unquote, investments in the past. So in one way, I'm also kind of playing with house money right now. So that changes my perspective a bit, but I'm still being pretty conservative. And I would suggest for anyone else, not financial advice, obviously, but just be very cautious. Be mindful of what percentage of your net worth any crypto investment is, because this stuff can just go to zero overnight. And I'm not saying that's going to happen. And certainly Bitcoin is not the Squid Game coin, which did go to zero practically overnight. Actually, it went to zero in a matter of seconds. You can listen to the actual moment that happened in an episode of the podcast. It's all about that Squid Game coin. So just be very careful, be mindful that it's speculative, know that you're gambling, and don't overdo it. So I hope that was helpful. This has been Compound Money Quietly, the CMQ Investing Podcast. If you enjoyed the episode, make sure you subscribe. Please share on social media. And remember what Charlie Munger says, the best thing a human being can do is help another human being know more. I hope this episode did that for you. And if that's the case, then help someone else know more by sharing it with them. My name is Chris Franco. Thank you for listening. We'll talk soon.